WatchGuard Capital. Invest your time wisely. I never wanted to make this video, but my conscience compelled me to, and it's that set of ethics that forces me to present only that which I believe to be true. My calculations could be off, investments may lose value, your tax situation specific. So this is not a recommendation, it's general information. Aren't disclaimers terrific? This story starts with a man who died, but more the widow he left behind, a life insurance policy payout, and the financial confusion that swirled in her mind. Her need for financial help and security and not knowing what she should do, an insurance agent, a reaped commission, and a corporation's expanding revenue. The salesman left the industry for reasons that still remain unknown. He wouldn't return her phone calls as to why her contract's value had never grown. A friend of a friend of a friend decided to send the widow my way. We had breakfast and some coffee, and then I completely ruined her day. We went over the terms of the widow's annuity. It was the worst I had ever reviewed. But that's just one man's opinion, which I still believe I'm constitutionally entitled to. The annuity company was Athene Holding Limited. Athene became a publicly traded stock in December of 2016. I pulled the United States Securities and Exchange Commission Form S-1 to get some background information on Athene Holding Limited, and two things immediately jumped out at me. First, the company is incorporated in Bermuda. Second, this is the first section of the report after the table of contents, and this is what Athene Holding Limited decided to lead with. We are incorporated under the laws of Bermuda. In addition, some of our directors and officers may reside outside the United States, and all or a substantial portion of our assets and the assets of these persons are or may be located in jurisdictions outside the United States. Therefore, it may be difficult for investors to recover against us or our non-United States-based directors and officers, or obtain judgments of U.S. courts, including judgments predicated upon the civil liability provisions of the U.S. federal securities laws. Although we may be served with process in the United States with respect to actions against us arising out of or in connection with violations of U.S. federal securities laws relating to offers and sales of Class A common shares made by this prospectus by serving CT Corporation, our U.S. agent irrevocably appointed for that purpose, it may be difficult for investors to effect service of process within the United States on our directors and officers who reside outside the United States. I did check Athene's website to see if there was any more information about its operations in Bermuda. I even checked to see if there were any job openings. The only position posted for in Bermuda was for legal counsel. If you're a lawyer and you want to work for Athene on the second floor of Washington House, 16 Church Street in Hamilton, Bermuda, which happens to be at the north tip of the Bermuda Triangle, you could work here in the Washington House on the second floor on Church Street of this building. According to the government of Bermuda's website, it doesn't have a personal or corporate income tax on profits like the United States, but it does charge various financial services taxes. But if you did work for Athene here, and you were put in charge of paying taxes to the government of Bermuda, you would only have to walk to here and pay them at the F.B. Perry building at 40 Church Street, about a 2-minute walk. But most Athene employees are going to work in Des Moines, Iowa on this campus and in this building. If you look up Athene through the Delaware Insurance Licensing tool, you'll only find a Delaware address for the statutory agent at 1209 Orange Street, which is this building that is associated with hundreds of thousands of companies in the United States. And that covers a basic review of Athene's history and structure. So again, this is Athene's website. And Athene sells annuities to individuals and groups. Athene sells various types of annuities to individuals. The widow was sold a registered index-linked annuity by an independent agent. Athene offers many different types of contracts he could have sold her, but he sold her this one, the Ascent Pro Bonus. Now this is the brochure for that contract, and I want you to imagine a woman who just lost her husband to cancer and is still grieving that loss, who just received a large lump sum life insurance payout and has to decide what to do with that money and is given a brochure like this one. And on each page, we're just going to read the words that Athene bolded and try and put ourselves in her shoes to see what decision she would have made. For income that lasts as long as your retirement. Athene, a different kind of company, a leader in annuities. Athene Ascent Pro can help you reach your retirement goals. Grow, protect, and enjoy your retirement nest egg. Create an income you can't outlive. Mind the gap. Making up the difference between guaranteed income and expenses is important to maintaining your lifestyle in retirement. Get the most income from your annuity. Grow your income base to maximize income. Create an income stream that can last a lifetime. Calculating your lifetime income withdrawals. Lifetime income withdrawal percentages, single life guaranteed. The Athene Ascent Income Rider is required minimum distribution friendly. Double your lifetime income when you and your family need it most. Income for life, guaranteed. Leave a legacy for your loved ones. Protect and manage your money with these additional features. And finally, additional information and the small print. There's a very good chance a grieving widow would find comfort in this brochure. But I'm not a grieving widow, I'm an analyst, so I'm going to need to know the details behind the expected growth statement of this annuity. What income for life means and how much that would be. The benefit of a premium bonus of 3% that doesn't start vesting until year 7 of the contract since she lives in Arizona. If she lived in these states, she would start vesting premium bonus in year 2. I'd also want to know how much money she'd forfeit or surrender if she wanted to get out of this contract if it didn't meet her expectations. In this case, she would forfeit 12% in the first 3 years, 11% in year 4, 10% in year 5, 9% in year 6, 8% in year 7, 7% in year 8, 6% in year 9, and 4% a decade later. I've only reviewed a handful of annuities to this level, but this is by far the most expensive surrender charge schedule I personally have ever seen. But, per the contract, the widow can withdraw 10% of the accumulated value of her contract per year free of charge before the surrender fees kick in. And to be fair and honest, here are the other pages of this product in case you want to pause this video and read them. Now these are the current indexes and interest crediting rates for the annuity as of November 2021, but these were not the same rates available to her in 2019 when the widow was sold the annuity. These were the interest crediting rates that were available, which could be found on page 3 of her 152-page long contract. The BNP Paribas Multi-Asset, S&P 500 Daily Risk Control 5%, S&P 500, and fixed crediting rates are on both lists, but the NASDAQ FC and AI-powered U.S. equity indexes were not available to her in 2019. And the Morningstar Dividend Yield Focus Target Volatility 5 and the Janus SG Market Consensus indexes were available, but don't seem to be available on new contracts. And since I was analyzing the contract the widow bought, these were the ones I reviewed and the ones I'll use to show how to formulate an expected rate of return estimate. But the takeaway is that you want to review the growth options available in any contract you are considering buying. So let's look at BNP first. So this is a robust disclaimer in terms of use agreement to get information on an index. My concern level immediately rises when I see something like this because in my opinion, the only logical reason to have a robust disclaimer system like this is the anticipation of lawsuits and complaints. If you hit decline, you get rerouted to BNP's main website and you can browse that site without agreeing to any terms of use. But I can't even enter this BNP multi-asset crediting index site without agreeing that I understand the possible conflicts of interest before I've even had a chance to do some research to figure out what they are, so that's not a good sign. What I'm looking for is index performance, and I want to download the daily closing levels since they rebalance daily. Okay, so this is what the downloaded data looks like, but this video is more about an Athene annuity and less about how to build an Excel sheet to calculate an expected rate of return on an annuity, so I'm going to give you the quick version of that process. First, I built a list of all sequential dates, and then I added a month and date column so that I could query and delete all leap days to standardize the date data to a consistent 365-day format. Then I used a VLOOKUP formula to find the index value for each date, or the next closest date's value if one wasn't available, which is why this column is the approximate value. And if you didn't understand that, you're absolutely normal and it doesn't really matter. What matters is that on 12/31/2002, per BNP, the index had a value of 100, and 365 days later, on 12/31/2003, the index was at 110.8463, or up about 10.8%. Now, the widow's allowed participation in that return was 55%, so I need to multiply that by 55%, which means her rate of return would have been about 6% for that year point to point. One other note is that the annuity had a minimum guaranteed rate of return of 1% per contract year, so if the index return was lower than that, she still got 1%. On December 31st, 2004, 2 years later, the index was up to 115.766, or about 15.8% for 2 years, if she had chosen the 2-year point-to-point option. The widow's allowed participation under that strategy was 85%, so I need to multiply that return by 85%, and her rate of return would have been about 13.4% for 2 years, or 6.7% on average for 1 year. Again, she had a guaranteed minimum rate of return of 1% per year if the index returned less than that amount. Next, run these calculations until the date you pulled the data, in this case November of 2021. Average all the annual point-to-point returns and the 2-year point-to-point returns, and my estimate for her expected rate of return would have been somewhere between 3.2 and 4.8% on average per possible contract year. Again, this is just one way you could calculate the expected rate of return on an annuity. I'll use a second approach for the next available strategy, the S&P 500 Daily Risk Control 5% Index. I'll still download the data, but instead of calculating the hypothetical return for every day, I'll do it just for the widow's contract date of April 9th, since that's the date her point-to-point rate of return would be calculated. In this case, the first April 9th index value in the data set is April 9th, 2012, and the index was at 151.8. 1 year later, on April 9th, 2013, the index was at 160.3, an increase of 5.6%. The widow's granted participation rate was 50%, or half, so she would have received 2.8% of that return. One more hypothetical year later, on April 9th, 2014, the index was at 172.43, an increase of 7.57%. The widow's allowed participation rate is half, so she would have received 3.78% of that return. A year later, April 9th, 2015, the index is at 179.89, up 4.33%. She receives half, or 2.16%. A year passes, April 8th, 2016, the index is 175.91, down 2.21%, so she receives the guaranteed 1% interest rate. I'll continue this process and calculate the index percentage change and her allowed participation rate for all April 9th dates in the dataset. Now, she didn't actually purchase this annuity contract until 2019, so most of those returns were hypothetical, but if I average them, her expected return would be somewhere around 2.93% on average. And there's no way that an annuity contract and a stock exchange-traded fund are in the same risk class of investments, but these are the returns of an exchange-traded fund that follows the S&P 500 index that isn't trying to control for volatility. It averaged almost 17% for the calendar years over the same time period. The next strategy that was available was the Morningstar Dividend Yield Focused Target Volatility 5 Index. A quick glance at the 5, 10, and 15-year returns suggests that an appropriate expected return on the index is around 3.3%, and we could stop there, but what fun would that be? So instead, we'll take these returns of the index and put them here, and indeed, the average of the index is about 3.3%. But for the 1 year point-to-point strategy, Athene declared a 45% participation rate, so these are the returns she might have experienced. The minimum guaranteed interest rate of 1% kicks in 3 times, so her average expected return for the 1 year point-to-point might be closer to 2.16%. For the 2 year point-to-point, I couldn't decide on the most appropriate way to compute the expected rate of return, so I tried compounding the rates every 2 years and then multiplying those by the Athene granted participation rate of 55%. The contract's minimum guaranteed interest rate of 1% kicks in 4 times, and the expected return averages out to 3.94%. The problem with this approach is that a positive or negative outlier year is counted twice. So I tried a method where I averaged the annualized returns from the 2 year rate of returns, a historical backtest as if the contract were bought on January 1st, 2011 and experienced these returns every 2 years, or was bought on January 1st, 2012 and experienced these returns every 2 years. And finally, a compounded adjusted growth rate approach utilizing the annualized rate of returns to derive an internal rate of return. And I'm still not sure which approach is most appropriate, but since these strategies yield about the same 2 to 4% expectation as the other possible strategies, it doesn't really matter to me, because in my opinion, these returns cannot meaningfully beat inflation and have a real chance of locking in a negative real rate of return. So who cares? It doesn't really matter to me because I'm not going to recommend utilizing either of these strategies. So let's go with 2 to 4% with an expected average around 3.3%. Moving on. So the next strategy reviewed is the Janus SG Market Consensus Index, and before we review its performance, it will make sense to review how the strategy is supposed to work. First, it has a market consensus filter designed by Janus Henderson that embeds a low volatility filter. For most non-finance folks, a low volatility filter is going to sound like a good thing, but for me who understands portfolio mechanics and standard deviation, and has seen how low volatility filters have been used in the past, I'm guessing that returns are reduced to such a degree to achieve that low volatility that it's actually a bad thing. But what is it? A low volatility filter is a quarterly selection of the 250 stocks exhibiting the lowest 3-month volatility among the 500 largest market capitalizations in the US. So that's actually promising. I mean, how far off from market performance could a reference index be selecting half of the underlying stocks from the S&P 500? A market consensus filter designed by Janus Henderson monthly determination of the weight of each of the 250 stocks based on its growth potential compared to its historical 3-month volatility. And I spoke too soon. If the index actively decides the weighting of those represented stocks, the performance could and will most likely be vastly different than the underlying index, even though 250 of the 500 stocks are represented. The index aims to stabilize itself during periods of high market volatility by reducing its exposure to the market consensus strategy. Again, for the average non-finance person, this probably sounds like a good thing, but I know that it means the strategy will go to cash when the market's going up or appreciating too fast, which isn't necessarily a bad thing, but don't take my word for it. The index includes a performance control mechanism, which improves the participation rate for buyers of any investment products linked to this index. However, the index can only grow up to a given limit every month. So if the 250 stocks in this index went up by 10% in 1 month, investment products linked to this index won't. How do I know that? Because this is the performance chart for this index. And the highest Janus SG market consensus return you'll see for 1 month is 4%. So even if the market was up 10.75% for 1 month, this strategy can only go up 4%. But if the market was down 2.7%, this strategy could be down 5.4% or 9.2% or even 22.9% because there is no cap on how much this index can lose per month, which by itself is enough for me not to use this strategy. But when I look at relative performance to the S&P 500, its own reference benchmark, it underperformed by 25.2%. It underperformed by 24.4%. It underperformed by 22.4%. It underperformed by 9.4%. It outperformed by 10.5%. It underperformed by 16.4%. It underperformed by 15.1%. So I could never recommend this strategy. The widow was 100% allocated to this strategy, which is why she called me. When I showed her this table, she asked me why she wouldn't just invest in something that was tracking the S&P 500 index. I let her know that her previous advisor was an insurance salesman, not an investment advisor. So the only way he could earn a commission is if he sold an insurance product, i.e. an annuity. The monthly capped S&P 500 index strategy was basically the same thing. Instead of getting up to 4% upside per month, she was capped at 1.4% initially. I looked it up and it's up to 2.75% this year. Who cares? I still can't recommend it since the investor absorbs the full downside movement, even if they are protected by the 1% minimum interest rate guarantee. The SPX 1 year point-to-point had a cap of 3% for the year, so it's in that 2 to 4% rate of return range expectation. So I'll pass because it won't meaningfully beat inflation either. So to recap, out of these 10 initial strategies available to the widow, I've ruled out 9 and I'm down to 1 to review, the fixed strategy. Online, that strategy guarantees a rate of return of 1.1% annually. It was 1.2% annually when she was sold this annuity in 2019. I think it has a minimum guaranteed strategy value interest rate of 1.45%, but who really cares? All those rates are well below my inflation expectations, so I can't recommend this strategy either. And now I'm in a predicament because I've ruled out all 10 strategies, which made me wonder how Athene, the company, is doing selling products like this one. In 2017, Athene was up 7.7% when the market was up 21.2%. It was down 22.9% when the market was down 5.2% in 2018. It was up 18% when the market was up 30% in 2019, down 8.2% when the market was up 21% in 2020, and up over 100%, meaning the stock price more than doubled in 2021 as of October 31st when the market was up only about 23%. Looks like revenue increased over $7.5 billion this year, and net income more than doubles from $1.45 billion to $3.65 billion, which is probably how they found more room to pay their top 5 employees almost $10 million more. As for my next steps, I ran a scenario where I maximized returns subject to 6% volatility, not because that's the optimal volatility level, but because that is in the ballpark of what annuity strategies we're attempting to do. I put half in the stock market and half in the bond market, which is between a moderate and a conservative strategy. The return optimization, limited to 6% volatility, said to allocate 37% to the stock market and 63% to the bond market, which yielded 6.5% expected rate of return, well north of those other strategies. So the question becomes, do I recommend that the widow leave the insurance money she received when her husband passed in the current annuity earning 3% plus or minus 1% and end up with an expected annuity worth around $109,000 to $118,000, which is a very tight range of outcomes, or do I recommend she cash out the annuity, take the 12% hit on the surrender fee, and invest the remaining assets in that 37% stock to 63% bond portfolio, which has a higher growth expectation that yields an expected portfolio of $113,000 to $185,000 over the same 8-year time span? Or do I relax the 6% target volatility requirement and recommend she put half in a stock market investment and half in a bond market investment, which yields an expected portfolio of $111,000 to $206,000 over the same 8-year time span? Since the theoretical worst-case scenario for the 50% stock, 50% bond investment portfolio after starting off with 12% less because of the surrender fee is $2,000 better than the worst-case scenario for the annuity, if my assumptions are correct, and the best-case scenario for the investment portfolio is $90,000 better than the annuity after 8 years, there is a very strong case that I should recommend that she cut ties with Athene and get out of this contract and buy some investments. So that's what I recommended she do with one of her annuities that was out of the surrender period because of the passing of her husband. It could be canceled with no penalties. For the annuity contract that would have to surrender 12% of its principal to get out of it, I recommended that she just move over the amount that was free of penalties, which was 10% of the contract's value, and invest that amount in an investment portfolio, and to do this every year after her contract date until she was more comfortable with the new strategy. And at any point in the future, if she was comfortable cashing out the remaining balance of the annuity and paying the applicable surrender fees, I would rerun the analysis to make sure that it was still in her best interest. This video was publicly released in December of 2021 and acts like a timestamp on my recommendations, and I'm looking forward to reviewing the performance of Athene's Ascent Pro Bonus indexes compared to my expectations and the simplified hypothetical investment portfolios presented. I could never personally recommend an Athene Ascent Pro Bonus annuity, or most annuities for that matter, for ethical reasons, but that's just my own opinion and stance. If your salesperson is recommending one, here are 3 pieces of advice. Ask these questions recommended by the United States Department of Labor and review your salesperson's answers before you enter into an agreement. Because annuity commissions can create such large conflicts of interest, get a second opinion from someone bound by a fiduciary capacity before purchasing one. And if you buy an annuity, go over every page of your contract with your salesperson during the free look-back period, which is typically the first 10 to 30 days of your contract, not just the truncated sales literature until you understand it 100%, because after that, the surrender charge period usually kicks in. That's it for me for now. I'm Stephen Blue with WatchGuard Capital. Invest your time wisely.